Hello, everyone. Welcome to video 5 in the Aerial Effects Mastering Your Psychology course. And in this video, we will be discussing psychology and losing streaks. So, losing streaks are a part of the game. You can't get around them. They do occur even to the best of us, even to professional traders. You will go on a losing streak, but it all comes down to how you respond to it. All right, so let's first take into consideration what the retail mind is going through and the results of losing streaks. What does it lead to? It leads to first revenge trading and over leveraging. So we've touched upon these concepts earlier in this course. So just to reiterate what these are, revenge trading is trading to try to make up for a loss that you incurred through either a loss that maybe you over leveraged or a set of losses trying to get back to break even or back into profit. And oftentimes that leads to not following your trading plan and just placing trades nonchalantly at random levels, not following your rules or having any confluences. At the same time, over leveraging, trying to get back into profit very quickly. The retail mind thinks, oh, if I just place double my risk or quadruple my risk or 5 times my risk, I can get back into profit very quickly. Well, coupling over leveraging with revenge trading together, which oftentimes that's what occurs, leads to quickly blowing your account. So this is what the retail mind is going through, and it most likely happens due to fear of failure. No one wants to fail. The human condition and human nature always wants to be in a satisfactory state, in a winning state, or in a happy state. So when they lose, oftentimes their psychology overtakes them, their emotions control their mind, and then revenge trading and over leveraging coupled together set in when losing streaks do occur because they are fear of failure sets in. They are scared of failing, they are nervous of letting someone down or letting themselves down and don't want to suffer through that pain and anxiety of seeing that blown account or big drawdown or severe cut in profit of all of their account balance. This, as a result, anger sets in and leads to revenge trading and over leveraging. So the question becomes, are you a part of the 95%? 95 to 99% of traders lose. Really, 95 to 99% of them not only lose, but quit within the first 6 months of trading if they even last that long. So are you a part of that 95%? How do we get you to overcome this and become part of the 5%? Well, we first have to understand the impacts that losing streaks can take you on. It takes you through an emotional roller coaster. You feel down in the dumps. You feel like quitting. You feel like giving up. You feel like the strategy may not work. You feel just overall bad. So, how can we lighten the mood and prevent anything further down the line from happening in your trading? You can't prevent losing streaks, but you can prevent the emotions that control you. So we first have to understand that this stuff happens in trading. And number one, using good risk management, not over leveraging on any position that you take in the market. This will prevent a significant blow to your account and then that constant cycle of blowing your account, refunding it, revenge trading, and over leveraging when losing streaks set in again. It's just that constant cycle. So we first have to understand that it is a part of the game and we can't get around it. But what we can do is manage our risk properly and manage our emotions properly when losing streaks come around. So first we have to be accepting of the fact that it will occur. But when, that's easier said than done, but when it does occur, obviously, through the human condition, your mind is going to naturally set in that fear of failure, anger, nervousness, the scared mindset of losing an account or letting yourself or others down. But we have to understand that if you do not over leverage, you're already setting yourself up for success. So when you do lose trades, you're not losing a lot. We have to be able to step back from the market and understand that we have to be trading each trade as its own trade, trading each trade individually from one another. Just because we lose a few trades, we oftentimes think that, okay, I can get into the market here at this particular level. And I'm sure that you can resonate with this because when you lose some trades, oftentimes your brain will try to find anything on the chart to trade, and it will think of a setup and come up with a setup right then and there. And you're convincing yourself that there is a setup, but subconsciously your mind is telling you to trade because you want to make that money back. So this is where we need that trading plan, and we'll talk about this later on in this video. We need to be able to stick to a trading plan and follow our rules. If we do this and build confluence with each and every trade, we will overcome this losing streak and get back into profits. Because obviously you're trading, if you are consistently profitable, even if you're not consistently profitable, you're trading with a strategy that has been proven to work, in our case, smart money concepts. So all we have to do is just manage our emotions when we do lose and then continue to trade as if nothing happened. And that just comes down with practice. But it's understanding that this stuff will occur, but it's about how you respond to it that's going to make the most difference. And obviously, it's easier said than done. But if you can, over time, learn to consistently use the same risk, I recommend no more than 1%, as we discussed earlier in the course. But then understand that losing comes as a part of the game. And if we can step back, dissect the markets again, and continue to trade using our trading plan and our rules and treating each trade as its own, over time, that losing streak will come back, turn into break even, and then turn back into a winning streak, and we're going to be net profit because we know the strategy works and we have high risk to rewards when we trade. Okay, so let's continue here. Quality or quantity. So many people will say, oh, I trade quality over quantity setups, but do they actually? Many people actually do take more trades than they should. If you have a 1 to 3 risk to reward trade and you trade 2 times a month and make 6% on those 2 trades because you're trading the best of the best setups, 6% for that month, that's like what, 72% a year? That's phenomenal return. So in all reality, we don't need quantity. We need quality. So are you taking too many trades? Are you finding yourself trying to trade every single day or every single week? You should only be trading when there are setups. Set realistic return goals. If you hit those goals, be done for that day, be done for that week, be done for that month, and continue to learn so that you don't lose profit by continuing to overtrade and losing the profit that you already made. This may also be a factor in taking too many correlated trades. So when you take too many correlated trades, your inherent risk in the market increases. So what do I mean by this? Well, if you see an NZD USD buy setup, and then an AUD USD buy setup, and then a Euro USD buy setup, if you're taking all of those buys, well, what happens if you lose and you're wrong on those trades? If it actually reverses on you, it not only reverses on one trade, but it's going to reverse on every single one of them. So then you have to take into consideration the correlation within your own trades and say, okay, if I'm going to be taking these trades, maybe I should lower my risk across the board so that if I do happen to lose one trade, which would probably lose all of them, that I would only be losing X amount, right? So it doesn't just come down to the entries and how we can be profitable and how many trades we win. It even comes down to how many correlated trades are we in or looking for in terms of setups, and then mitigating your risk through adjusting each individual trade's risk to go with how many correlated trades you have open. So we have to be able to trade using quality setups versus quantity setups. The more confluences you can build for a particular setup is going to do you wonders. It's going to give you a higher probability that you will succeed with that trade. If you only have 1 or 2 confluences as a part of your trading plan, well, you need to think about revising that trading plan to add more in. Because the lower amount of confluences you have, the easier it is to find a trade, but that trade is probably not as highly probable as ones that need more confluences to be entered. And like I just said before with my original example, you can easily find a 1 to 2, 1 to 3, 1 to 4 trade. So you only really need about 2 or 3 of them a month. But yet, so many people are trading more. If there are more setups, then sure, you can take more trades if the setups present itself, maybe lower your risk. But the question really becomes, are you following your rules? And are you trading each trade as its own? Is it a quality type of setup? Or are you just trading for the sake of trading? Many people will see the ridiculous markets that could come around in August time or December time, because usually around those times of the year, the markets are quite erratic and low volume, and they don't see too many of their setups because there are seasonalities within the market. Things change. But you're so used to trading all of springtime or all of fall time, and then when summer and winter roll around and there aren't as many setups or the market is not respecting well enough and you're not taking as many trades, you think you're doing something wrong. In all reality, you're not doing anything wrong. You're just not seeing the setups on the charts that fit your rules. But yet you still continue to try to trade them because you want to be a part of the market. So many people are so addicted to trading. It is very addictive. It is like gambling. They always want to be a part of the market. They want to have stake in a trade because it gives them that adrenaline rush. So if they're not in a trade, they can't participate in that adrenaline rush. Why take a trade if your rules are not met? You have to treat it as like you're doing this full time, like this is a business. So if you, let's say you were managing other people's money, would you be willy-nilly with your trades because you want to be in them, knowing that they're not the best trades and they're probably quantity over quality setups? No, because then you're going to see that balance decrease in that blown account, and now you're going to get people yelling at you for blowing their money. Treat it like you're managing other people's money, and you're going to do a lot better with your trades. And understand that certain times of the year, and even certain times of the month, you're not going to have as many setups as before. Some weeks we have 10, 15 setups a week. Some weeks we may have 2 or 3. But it's because we stick to our rules, we're able to be highly profitable within those weeks. Some weeks, great weeks, some weeks, not so great. Meaning where we stay out of the market and not trade. Because we only trade when our rules are met and when a setup arises. The game of probability. So this kind of ties into what I was talking about. Is your trade a highly probable trade? If it is, it's probably a quality trade. If it is not highly probable, it's probably because you're just wanting to get into the market and trade and basing it off of how many trades can I get in. The more trades you get in does not mean you will make more profit. More trades do not equal more profit. More trades probably do equal less profit or even a loss at this point. Understanding realistic returns. This has been a major key concept that we've been talking about throughout the entirety of the course as well. So this will also tie into quality over quantity in your losing streaks. When you're in a losing streak, you tend to trade more. Over trading leads to quantity types of setups and not quality. When you're on a losing streak, you're obviously losing money and you want to go back and hit your return goal. You want to get back to that 20% unrealistic return goal because maybe you're down 5, 10%. So that leads to over leveraging. That leads to setting more unrealistic returns and trading quantity setups versus quality setups. And in the end, if you let your emotions get to you and you're doing all the wrong things that what I'm talking about here, it's going to cycle in and exponentially grow negatively. Meaning it's just going to produce bad habits, and it's going to be that constant cycle of you having to reboot your account, refund your account, whatever you want to call it. And you go through the same cycle because you're practicing the same things over and over again. So set realistic returns. And what does that look like? And what is that actually going to do for you? I would say realistic returns for a type of strategy that produces high risk reward trades, probably anywhere between 5 to 10, maybe 15% a month. And that's really hitting maximum. Many people can't really even do 10%. And that's just because they over leverage and they don't know what they're doing and they're letting emotions control them. So they're automatically going into the negative. But if you do everything right, then your return should probably be around, maybe 3 to 5, maybe 10% at most. That's setting realistic returns. And what that will do for you is that will prevent over trading because you're not seeing your account go into drawdown that much because you're using good risk management and you're providing yourself with quality setups versus quantity setups because you're not aiming for such a high unrealistic return. So many people will think about their returns in terms of the week or terms of the month, but look at it in terms of the standard and in terms of the year. If you do 5% return a month, you may think for that particular month it's awful. But if you do 5% return every single solitary month for a whole year, that is 60% return on investment. That is a phenomenal return. But yet you still think that 5% is bad because you're thinking so short term. You're not thinking of the bigger picture. You're not thinking of the long term here. And especially 60% return compounded, compound 60% return a year for 10 years, whatever account size you want. You're going to be baffled. Your jaw is going to drop, but it's real. Think about it. If I have a 100 grand account and I do 60% return on it, which is 5% a month, I made 60 grand. So now I have 160 grand in my account. Do another 60% return the next year, 5% return a month. Now I made 96 grand. So I made the same percent return, but yet with the compound effect, I made 60% the first year and 96% the second year. That's an increase of over 50% between the 2 years. That's an increase of $36,000 from my 60,000. Now do that again. 96 grand plus $160,000 is 256. Now you're sitting at $250,000. You do 5% a month the next year. So that's times 60%. You've went from making 60% the first year to 80% the second. Am I doing the math right? Maybe I'm not. Anyways, the third year you did $153,600. That is an amazing return. So that is why we need to be able to understand the compound effect and set realistic returns. And it all ties together. You set realistic returns, you're probably not over leveraging and you're not over trading because you don't need to hit such a ridiculous return goal. That way, you can look at more quality setups and not quantity setups. Therefore, that leads to when you are in a part of losing streaks, you're not having your emotions control you by wanting to overtrade and over leverage because you're using good risk management and you're setting high probability trades and realistic return goals. So it all ties together. When you are in a losing streak, many people will think it's the strategy that's bad. We need to correct this mindset. People hop around from strategy to strategy when they're in a losing streak, thinking that the strategy is bad because they're losing. Many people will take a course or watch a video and then immediately go and try to apply it and then immediately fail. And that is normal, and that is fine, and that is okay. But in their mind, it's not. They think it's the strategy. You don't pick up a guitar the first day and immediately become a professional. You have to practice. So when you start playing it, you're going to sound like crap, right? You're going to fail. But that you have to be able to continue to practice and understand that what's being taught to you may be actually very good, but you're just not putting in enough effort and enough time and enough patience to gain that experience to then make it work for you. So that is why so many people, and I'm sure most of you out there, have probably hopped from strategy to strategy, from group to group, doing different things here and there, because when you try to learn something and you can't apply it initially, you think it's the strategy that's bad, or it's the mentor that's bad, or the person teaching you who doesn't know what they're doing. In all reality, it's just you. You don't put in enough effort. You don't take the time to make it work for you. You want, because you want instant gratification. You are too impatient. And you think you're supposed to become a professional and start to apply it immediately right when you learn it. That's not how anything works in life. If it were that easy, this world wouldn't be what it is today. We wouldn't have such a wealth gap in society if it were that easy. You have to know that this stuff is a process. It takes time. So yes, you are going to fail initially. I failed initially with it. Yes, I wanted to give up too, but I didn't. because it's through the experience is what the real teacher is. Nothing gives you more clarity than experience. The real teacher is truly experience. So we have to correct the mindset to say, okay, look, I'm taking a course or I'm, trying to trade this concept and I'm on this big losing streak and I keep losing. It's not necessarily the strategy that's bad. It's just you don't know how to properly apply it yet. And you're trying to, but you can't see this because you don't have the experience with it yet. But as you go, and if you don't give up on things, and you keep practicing and practicing, and it slowly ingrains in your brain, and you start to see things that you didn't see the first time, even though you saw all the original information, because it works upon itself. It gets locked in your subconscious. This is how learning works in psychology. If any of you have taken a psychology class in university before, you'll learn about how that works. Repetition creates habit. I say this all the time. You do something, I think in psychology, it's like 21 or 22 times, it becomes a habit, right? So doing something over and over and over and repeating the process in a good way for education is going to be it's going to do really well for you, because you're going to fail initially. But if you keep working towards it and learning from your mistakes, you're going to realize that the strategy is really good. But people just don't want to take the time to actually learn it, which is why they continue to hop around from strategy to strategy, trying to find the golden strategy when in all reality, there's no such thing. It's just they're too lazy to actually make it work for them. So that kind of ties into lack of effort and patience. Impatience. People are too impatient to learn from their mistakes. They don't have the effort. They don't put the time in to make it work. They think they should automatically become profitable instantly after learning something. Good things truly take time, guys. If it were that easy, anyone and everyone could do it, and the world would not be what it is today. Don't let it affect your personal life. So when you go on these losing streaks, because everyone goes through them, I go through them, you go through them, even the best traders in the world go through them. Take a step back and think about what it does to your emotions. Kind of look at what you're thinking, in a sense. Just step back and view your thinking. Are you feeling angry? Are you feeling sad? Are you feeling mad? Recognize what you're feeling, because this immediate feeling when this stuff occurs, when losing streaks occur, are always going to be negative. The only way to turn it around to make it a positive is if we recognize what it does to us. So now we can take control over it and change it. Like I said before, repetition creates habit. This also could be a bad thing. If you're on a losing streak and you're creating the habit of over leveraging and over trading and getting angry and screaming at the market and your laptop and thinking that it's the strategy that's bad, and continue to go through that same cycle over and over of hopping around from strategy to strategy when you lose, and then keep having to refund your account because you keep blowing your account because you can't maintain good psychology when it comes down to losing streaks because you're over leveraging and over trading and having quantity over quality setups. This cycle is going to continue to repeat itself, and it's going to create a habit into thinking that something has to change eventually, but you're not changing anything. This is why the cycle continues. So you have to get this ingrained in your brain. Nothing is going to change unless you make a change. So this can definitely be a bad thing. So we have to let go of these emotions, and it's not something that you can do overnight. I'm not saying it's true. You're going to have to take some time and practice it. No one is ever going to instantly master their psychology in a day. But if you understand the problems that you face, or the problems that maybe you don't even know you face, and we have solutions to those problems, then it's only going to work upon itself. And over time, you can see how it's affecting you and what you need to do differently to change it. We also have to understand how it affects our mood, because trading will definitely affect your mood. You're on a winning streak, boom, you're happy-go-lucky, you're giving everyone hugs, whatever. You're on a losing streak, all you want to do is sleep. All you want to do is get into bed and crawl up in a ball and sleep. Maybe you just lost $100, maybe even $1,000. Maybe you blew your prop firm account. It affects your mood, but it also affects everyone else around you. You maybe yell at your friends or yell at your parents or yell at your spouse or yell at your kids because you're taking it out on them for your failures. So let's take a step back and ask yourself, are you seeing this transition into your everyday life? Do you become a bad person in your everyday life because of trading? Does trading, when it gets the best of you and you're on losing streaks, does it negatively impact your personal life and how you treat others and how you go about your day? Because if you go on a losing streak, you're probably upset. You're probably not wanting to see anyone. You just want to be lazy. You just not want to do anything. Even though you have responsibilities, even though you have people who love you, it will negatively affect you. So we first have to figure out how we can correct and prevent this issue. How can we not let it affect our personal life? And this all comes down to building clear rules and clear plans for our trading. We have to clean up our trading first before we can clean up our psychology. So many people will ask, well, how can you clean up your trading if you don't clean up your psychology first? Well, they kind of go hand in hand. If you have an established trading plan, if you don't cut corners while you are creating this plan, if you understand that you're supposed to be looking for quality over quantity setups, if you understand that you have to be risking 1% or less per trade and not over leverage and not let the market affect your emotions when you lose and not over trade, if you can do that, when you have losing streaks and accept the fact that they do occur at times, and understanding that once you just get over that hump of a losing streak, you're going to get right back on it and you're going to get back on a winning streak. Obviously, you'll get on a losing streak again, but if you can understand that it happens and you're overall profitable because you're doing everything else right, you're not going to have the problem of being down in the dumps. It's going to eliminate that issue. So I know a lot of people, I've had a lot of friends who are traders, have taken their anger out on other people because of it. They never did anything to you. Why would we be doing that? Go yell in a pillow or something. Relieve that stress. Go on a walk. Take a drive. Just get outside. But don't let it affect your personal life and how you treat other people. But if we start to do the little things right, it can eliminate those bad feelings. You're still going to feel bad when you lose, but it's not going to be as bad because what you did correctly was you didn't over leverage and you didn't over trade, and you had a trading plan and you followed your rules and you had quality within your setups and not quantity. So at the end of the day, you have to know that you're doing everything correctly, and it's just the market going through a seasonality or maybe a higher time frame structure shift that's preventing lower time frame trades from being entered, and there's nothing to avoid it. Sometimes it happens, and we understand that it does happen and it will happen, then we're better equipped to handle it. So don't cut corners when it comes down to creating clear rules for yourself. Establish a trading plan. Many people don't even know what a trading plan is. If you don't follow a trading plan, you're not staying consistent with what you're doing. And consistency is so crucial in this industry. Trading is supposed to be the same every time. You're looking for the same things. If you're inconsistent, especially with your emotions, it's just going to haunt you for the rest of your life because you're never going to actually make money from trading. Lose the crowd and avoid the obvious. And this is something that I've been teaching for a while. Observe the masses, do the opposite. That's our trading strategy. Look at what retail is doing and do the opposite. Retail loses. That's how the institutions make money. That's who's driving the price. They attack retail trader stop losses. So lose the crowd. Don't be sheep. Avoid what everyone else is doing. Because if everyone else is doing something and you follow it, you're doing something wrong. But if you find yourself doing the opposite of everyone else, you're probably doing something right. Think about it like this. If you're finding yourself staying home on a Friday evening and Saturday evening, learning how to trade and reading books and just growing in your personal, spiritual, and mental and physical health when everyone else is going out partying and drinking. That's what the crowd is doing. That's what everyone else is doing. And you're not doing that. So that means you're probably doing something right. Because no one wants to sit at home and read on a Friday night. They want to go out and party. That just leads to a bunch of other issues. But if you know what you have to do, that's correct. That's right. That goes against the herd, you're going to be doing a lot better than them. It's the same thing with trading. If you establish a clear trading plan, establish clear rules, and you don't cut corners, and you sit down and really plan it out, and you're not subject to the obvious of what everyone else is doing and how they're trading, you're setting yourself up for a lot of success. And use your intuition. Intuition's big in trading. And stick to your discipline. Sticking to your discipline, being consistent, is what's going to drive habit and overall in the long term more profits for yourself. So the exercise I want for you guys to do today is, if you don't already have a trading plan, let's develop your trading plan. So the essential components to consider when creating a trading plan is a confluence checklist. What do you need in order to say, okay, I am okay with entering this trade now? What confluences based upon the strategy that you are trading with, could be smart money, could be anything else. What is the if then this? If then this, if then this. What is that? Write down the list of the if this happens, then this will happen. Meaning, I have to look for liquidity. I have to look for time of day. I have to look for, a structure, higher time frame objectives. These are my confluence checklists. This means that you have to have those confluences in order to place the trade. Maybe if you have a list of 10 confluences, maybe you tell yourself, if I need 7 out of the 10 confluences to deem this an appropriate trade for myself. Write down a confluence checklist. You need a set of rules and criteria needed for entry. So this kind of ties into confluence checklist. Also, pick your FX pairs wisely, right? We don't want to just trade GBP JPY because everyone else is trading it. If you want to trade it, then you trade it. But if everyone else is trading it, it doesn't mean that you have to, right? Find pairs that work for you. Find pairs that go along with your particular strategy. Like for me, I don't trade cryptos. I don't trade futures. I don't trade stocks. I don't trade commodities. I don't trade, anything else. Indices. I only trade Forex because I know how Forex pairs move. I don't know how the other markets move and other asset classes, so I don't trade them. I specialize and I don't diversify. Because if you diversify, you're knowing a little bit about everything. But if you specialize, you're knowing a lot about a little. And knowing a lot about a little, and if you specialize, you can really hit home with just a few pairs and master them, and then present yourselves with even better setups because you know how they work and know how they move because you've mastered them. What trading sessions / time of day are you trading? Are you trading during a session where those currencies are not actively being traded? Euro USD doesn't really move in Asian session hardly. It's a London and New York session based pair. Are you trading during times of high spreads? Daily time frame closures? Are you trading during times where you may incur a lot of swap charges or commissions, meaning end of day or end of week? Understanding that manipulation in the markets occur during certain times of the day. So we want to trade during times of manipulation where we can observe the manipulation and then trade as a result of that manipulation to continue with the overall market moves. So for an example, if you're trading during Asian session and you're maybe trading lower time frame in a range somewhere, well, London session has a lot of manipulation that comes with it. So if you're in a trade during Asian, you may be manipulated and hit your stop loss from London session, and then it may turn around and go in your overall direction. But you were manipulated during the sessions that are highly active and more volume and volatility come in. So maybe we need to start trading during times like that, understanding when the manipulation is, identifying what it looks like, and then trading based upon that. where the institutions are going. And that just comes down to the smart money concept strategy that we have. Risk management. How much are you risking per trade? Do you have multiple positions within the same pair? How are you going to split up your risk? Do you have different take profit levels? If so, you're going to have to split up your risk even further to place each and every trade at different take profit levels. Are you documenting your trades? This is very important. Document your trades. This is how you can go back and learn from them. It's funny because I have a journal of all the trades that I've been taking for the past like 3 or 4 years. And I go back to the ones that I first put in there back in like 2018, and it's just ridiculous how like dumb I was. And you'll find yourself laughing at it later. It's just because as you gain experience, your trades will get better, and you're not using the same old type of way of trading that you did now because you've learned from it and refined it. But documenting is so important because you can go back and learn from your mistakes. What did you do right? What did you do wrong? And then apply what you've done wrong to the next trade so that you don't have that happen again. But if you want to make this a whole lot easier, if you trade smart money like us, just ask for ours. We'll definitely give you our proprietary trading plan absolutely for free. We have everything a part of the essential components. We have a confluence checklist. We have pairs that we recommend trading. We have a full set of rules and criteria needed for entry. We have a risk management plan. Documenting your trades you have to do on your own, but we understand what trading sessions and times of the day we should be trading. We have that full list. So please, after this video, feel free to hit us up and ask us for our proprietary trading plan. We'll be more than happy to provide that for you. So I hope you enjoyed this video on psychology in losing streaks, the problems that many traders face when they go through losing streaks, many problems that you may face in your current trading when you go through them, and maybe some problems that you didn't even know you faced. So the whole goal is to unravel the stuff that maybe you didn't even know that you face currently when you go through losing streaks, but also hit home on the problems that you are facing and you are aware of so that we can work on them and provide solutions for them. So thank you. Hopefully you enjoyed this video, and let's get ready for video number 6.